Hey guys. So the federal budget has been handed down and a lot of it was around negative gearing and capital gains. So I just wanted to run through how this actually works in practice with a few numbers. So I've got a few examples here. There are a lot of numbers and a bit of detail in here. I've tried to keep it as simple as possible, so don't get worried if you don't get confused with all the numbers and stuff here. We'll just try and keep a high level overview. So a couple of examples here. So with rental properties, to help you make a decision on whether you proceed or not, and what type of investment you make from there. So just to give you an idea, so I've got some numbers here. So the first column here, so with pre-COVID, what a rental property looked like prior to COVID, back in the good old days. So the property value back then, if we're looking at a property around about $500,000, we were getting around $450 rent per week, and interest rate on 100% lend of that property, you're looking at around 4%, give or take. Again, so these numbers are just very rough numbers to give you an idea of a bit of a summary of where things sort of sit. So your individual situation could be completely different, but here's a very rough guide of where things land. So the cost back then, probably about $8,000, which means that with your interest and your costs on that property were roughly $5,000 more than the rent you were receiving. So back then, $5,000, if you had a tax rate of 32%, you were saving about $1,600 in tax. So your out-of-pocket cost was around $3,400. So fast forward to post-COVID and post-budget. So we've got two different options here. So obviously we've spoken about if it's an existing property or if it's a new property or an eligible property. So it could be a commercial property or a new build, the definition of a new build that is eligible for negative gearing. So a place that was $500,000 a few years ago, that equivalent property is now around about $800,000. So more than likely, it's probably more than that. I've just tried to keep it a bit conservative because that seems to be about the entry point, give or take, of rental property from what we've seen lately. So obviously it could be more, could be less, depending on the location you're looking at. So to compare apples with apples, so $800,000. The rent per week, obviously rent's gone up to $700, so roughly $450, give or take. The interest on 100% lend is now 6.5%, give or take. So we've now gone from borrowing 4% of $500,000 to 6.5% on $800,000 on a similar sort of a property. So our costs to maintain that property, so council rates, things like that, insurances, are now about $12,000. So one sneaky extra tax in here as well, land tax. So depending on how you're structured, on an $800,000 place, you may have no land tax at all, or you may have to pay land tax. So in this example, I've said that the Queensland government is going to sting you $3,000 worth of land tax on this example here, on top of everything as well, because the land value has increased over time. So I know that the Queensland government has sent out a lot of updated valuations just recently. So if you currently have a rental property, you've never paid land tax, depending on the situation, you may have to, depending on their increased valuations now. So effectively, out of pocket, that works out to about $30,000. So whether it's current, whether it's an existing property or a new property, the facts are still the same, so you're out of pocket about $30,000. So this is where the new budget will kick in. So can you get a tax deduction for that $30,000 or not? So if it's an existing residential property, you can't. So there's no tax saving, so you're out of pocket $30,000. So you need to come up with $30,000 post-tax to fund that rental property. If it's a new or eligible build, you can save, if we're still on 32% tax, we're saving $9,600 in tax. So your out-of-pocket cost will be $20,400. So again, $9,600 tax saving in this example at a 32% tax rate. So if your stats are different, or if you have a higher or lower tax rate, so if you're in the highest tax rate at 47%, you're getting nearly $15,000 back in tax in this example here, as opposed to if it's an existing place, you won't be getting anything. So that is how the negative gearing changes will work on a year-to-year basis. But one thing that's probably not factored in here is this $30,000 here. You can use that to offset your future capital gain, whereas over here, you can't. You get the tax deduction year to year, whereas over here, you get to claim that against your capital gain in the future. So to put it into perspective, to look at the situation as a whole, let's look at the capital gain. So if you sell this $800,000 property in 5 years' time for a $300,000 gain, what does the tax overall look like? Okay, so over the 5 years, on a new or eligible property, if it's negatively geared, over that 5 years, you will save $48,000 in tax, so not 9,600 times 5, $48,000 in tax during that time. But when you sell, the capital gains tax on a $300,000 gain, because if it's a new property, you get the 50% discount, and the tax will, if you're in the 32% tax rate, you're looking at about $48,000 in tax. So overall, you've saved $48,000 in tax in the first 5 years, and then you paid $48,000 when you sell it. So overall, the total tax is zero across the board from start to finish, no tax. So if it's an existing property, so there's no negative gearing, so there's no tax saving during the time. But when you do sell, we can use 5 years at $30,000 negatively geared against the gain. So again, with an existing property, we can't use the 50% discount, we have to use the indexation method. So depending on what the CPI is every year over those 5 years, again, that's one thing that we don't know. So on an example of say 2.5% CPI for 5 years, we're looking like capital gains tax of around $14,400 when you sell this property here. So overall, so your total tax overall will be $14,400 on an existing property. So in summary, if you are going to buy a property, an investment property now, the difference between an existing residential property or a new residential or commercial property, if you're buying it for $800,000 and if you sell in 5 years' time for a $300,000 gain, the tax difference will be about $14,500, give or take, depending on obviously a lot of different factors in here. But that should give you a bit of a summary on areas to look at and strategies to look at going forward to make money on your investment property. So any questions, reach out.